We're now going to hear from Mary Holm. And before Mary speaks, I was looking at some statistics, New Zealand numbers, earlier this morning. And it's interesting that currently 16% of our population in New Zealand are in retirement. But in 25 years' time, that's going to increase to 26%. So that means a quarter of all New Zealanders will be retired in 25 years' time. So that is a massive increase in numbers, but also in issues, and as we heard from Barry, in the way that people want to live in retirement. So it's very appropriate that we welcome shortly Mary Holm. Many of you may well have heard of Mary. She's has been on Radio New Zealand quite a number of times, but she received her ONZM for services to financial literacy, education, and she's written 7 books, including Rich Enough, a laid-back guide for every Kiwi, and her latest book, A Richer You, How to Make the Most of Your Money, and both have been #1 bestsellers here in New Zealand. Mary writes a personal finance question and answer column in the Weekly Herald. She presents seminars and discusses personal finance with Jesse Mulligan on Radio New Zealand. Mary holds a degree in economic history, journalism, and has an MBA from the University of Chicago in finance. So please welcome Mary Holm. And before Mary comes, she has told me that she's very happy to take questions from the floor. So as Mary is presenting, please raise your hand if you've got a question, and I'm sure she will answer that. So please welcome Mary Holm.
Thank you very much, everybody. Now, looking at attacking debt, which I suspect if most of you are Cambridge partner clients, you probably do not have any of that silly debt. But I find it's good to talk to people. What I say often applies to your children, grandchildren, parents, brothers, sisters, and so on. So sometimes there are some thoughts here that you might want to pass on to other people. Getting the best from KiwiSaver, the importance of diversifying, which was one of Scott's messages earlier, being braver about risk, keeping on contributing whatever's going on in the markets, and then my favourite bit is relaxing and watching the money grow. Finally, a little bit about getting advice and how I feel, what's the best way to go about doing that. So attacking debt, the high interest loans is the one that I suspect won't apply to terribly many of you, but does apply to a depressing number of New Zealanders, and then we'll look a little bit at mortgages. I think what people do when they buy stuff with credit cards worries me really. Does its value rise or fall? You know, we buy, if you're borrowing money to invest in property, which is the obvious one people do, then its value will probably rise, although not in the last year or so, but usually its value will rise. But if you're borrowing money to buy something that loses value, travel's an interesting one, isn't it? Because you tend to run up credit card debt to travel, and does that lose value over time or not? I would argue that it quite possibly you get value over the years from travel you've done. So, but there are a lot of items we buy, clothes and things like that, and if we're going deeply into debt to do it, it gets awfully silly. The unbeatable investment, the best investment of all, is paying off a credit card or a car loan or whatever with a high interest rate on it. Paying off a credit card debt with 20% interest, and a lot of them do charge around about 20%, is the same as earning 20% on your savings. It improves your wealth in the same way as saving and earning 20% interest on your savings, and that's after fees and after tax. It's an impossible investment to beat, is paying off high interest debt. So if you or anyone you know has got that sort of debt and has run it up, I really encourage you to point that out to them. It's getting rid of debt is just as good as raising your wealth in terms of your long-term net wealth. Okay, looking at mortgages. Now, have you been given handouts? Did you get your goodie bags yet or not? You have, because in those there is a single sheet of paper that's got all the websites that I talk about in this talk. So there's no need to write them down because they're all there for you. A lot of them are on the Sorted website, which is the one that's run by the Retirement Commission, and I recommend that because they're totally unbiased. They're not trying to sell you any particular type of product or anything, and they do some good. So I've actually helped them with some of their tools, so I would say that. But they are good quality tools there. So on the mortgage calculator, what I wanted you to look at here is, so we've got $500,000 loan and term of 30 years and a fortnightly payment of $1,238. And one thing to just notice over there is that you've borrowed $500,000 and you're going to pay interest of almost as much as the debt. Quite often that's the case with mortgages, and in fact as interest rates have gone up, you can quite often end up paying more in interest than the actual principal that you pay back. And people don't always realise that, so it's really a good idea to get your mortgage down faster than you absolutely have to. So moving from the last slide to this one, we've got increasing the payments by $200 a fortnight, so $100 a week. So we're moving from, let's see there, you see $1,238 repayment there to $1,438 repayment here. And what that does by paying off just $100 more a week, you've got your term going down from 30 to 23 years, which is getting rid of that mortgage debt 7 years earlier. Quite a few people, who in this room has got rid of their mortgage? Yes, I thought so. I thought there'd be quite a lot of you here. Isn't it a wonderful feeling to get rid of that? And to do it 7 years earlier, it not only gives you 7 years of not having the debt hanging around anymore, but it also gives you 7 more years to be saving for retirement, unless you, of course, go and then buy a more expensive house, which is another thing quite a few people do. But the other point, so you've paid $100 more a week, you've paid off the mortgage a whole 7 years earlier, and you've paid $139,000 less in interest, which is huge. And that's real money. People sort of say, oh yeah, theoretically this, theoretically that. That's actually money for you to spend in retirement that you make by increasing your mortgage payments by not a heck of a lot. I've had this slide going for a few years now, and I realise that right now it's not all that easy for people with mortgages to be told they should be paying even more, because everyone's mortgage has been going up as their terms have rolled over. So it's just something to keep in mind and to get those mortgage payments down as and when you can. Okay, look, probably my favourite topic really is KiwiSaver. I've written 3 books about it and got very excited when it first came into New Zealand, because I was in America when they brought in their equivalent, which in those days was called an individual retirement account, and I wrote about them in the Chicago Tribune, where I worked as a business journalist, and came to New Zealand years later. KiwiSaver comes in, same thing all over again. I thought this is going to really catch on, and it has. It's fantastic. Are there people here who are not in KiwiSaver? Do you want to say why? Yeah, okay, you've retired and you've taken the money out. I hope to convince you might still want to get back in and use it, because it works really well in retirement, actually. It depends what you're doing with your money, but anyone else with any other reason you're not in? No, okay. We'll talk about why it's so good and which fund is the best one to be in. Now, this table looks a whole lot of numbers at first, but let's look at somebody on $40,000 over on the left-hand side there. This is an employee. They're putting in $1,200, which is 3% of their pay. The employer's putting in $990 because the employer also puts in 3%, but that's taxed. So after tax, $990 goes in. Government's putting in $521. When you look at the total amount of money that's gone into KiwiSaver, it's 2.3 times what you yourself put in. And then when we look down at someone on 100,000, they're putting in 3,000, companies putting in 20,000, 2010, government's putting in 521. It's still 1.8 times what they've put in. And the point about these times is that if you've got twice as much going into your retirement scheme, you get twice as much out in retirement, and people don't always realise that. So in KiwiSaver, you're steadily putting money in. If you're putting it in and you would otherwise, if it had been another savings scheme, have ended up with 100,000, in KiwiSaver you're going to end up with about 200 or more, depending on your income level. Very powerful. The self-employed or people who are not working, people at home looking after children, etc., hopefully anyone you know who's in that situation, really try and get them to get the 1,043 a year in there. $87 a month is a good way to do it because you're getting the money from the government. It's a real pity to be missing out on that money. And then you end up with 1.5 times as much as you would otherwise have had in another savings account. So it's a pretty darn good deal. When you're buying a first home, after 3 years, everyone on any income can withdraw money. You probably know about that. But a lot of people don't really realise, and this is something that might apply to your children or nieces and nephews, neighbours, whatever. The first home grant, money free for you from the government, applies to a lot more people than people think. It's not just for people who are really poor. It's extra money coming in from the government, $5,000 after 5 years. If it's a couple, it can be $10,000. And if it's a new build house, they double it. So it can be up to $20,000 for couples, which is a really nice boost on people's deposits. Christchurch, the price cap is $550,000 on existing homes and $750,000 on new. So look, you can't buy a flash house. Do you like my picture of the sort of house you might get to buy? But there are houses out there that are priced at that level, and so people can get up to $20,000 per couple coming in from the government. There's a household income cap for one person with no dependents, it's $95,000, but for others it's $150,000. So it's not for everybody, but just make people aware that there's money there that they might not have known about. And this is something that a lot of people don't realise. Previous homeowners who no longer own a home can also get that money from the government. It's usually people who have been through a marriage breakup or a bankruptcy or business failure that are in this position. They've had to sell their house and they're renting. So you no longer have a home. The same house price and income caps as we've just talked about for everybody else. There is an asset test. So they look at your cash and your investments outside KiwiSaver, boats, caravans, and all of that. And so it doesn't apply to people, to everybody, but there are a lot of people who are, who've, as I say, been through a marriage breakup or something like that, who can get this free help from the government and don't realise it. So that's on Kaingora website, which is the Housing New Zealand website. That information's outlined on there. Now, which KiwiSaver fund to be in? Because most of you are with Cambridge Partners, you probably are with good KiwiSaver funds, but I venture to suggest most New Zealanders are not in the best one for them. We're talking the fund and the provider, but first we'll look at the fund. So on the Sorted website, they ask 3 questions to find out what risk level is right for you. And the first question is, I went want to use my KiwiSaver money in however many years, and the next one is over a given year, I'm comfortable with this possible gain or loss, and there's a range of gains or losses. So it's basically gauging when you're going to spend the money and how you feel about volatility. And then the third question is also basically about volatility. So there's just 3 questions there that you can click through and make your answers, and that will tell you which KiwiSaver fund you should be in, whether it be a low risk or a high risk. Now this graph's just an interesting one I saw a while back. It shows you what's happened to KiwiSaver funds through the global financial crisis. And you can see there that the green one, which is aggressive funds, the riskiest of all, is doing best or second to best, and then it's by far the worst in the downturn, and then it goes up to being best or second to best again. And the orange one, similar, that's growth funds, which are slightly less risky. And then meanwhile, the purple one in the middle is the very lowest risk KiwiSaver funds at all, and it just went straight on through the global financial crisis, not going down at all. So that shows you, what can happen in a downturn is the ones that normally do the best do the worst, but they come right again. Second choice is which provider to go with, and this is always controversial. Should you go with the one that's given the highest returns in the past? Should you go with one with the lowest fees? Should you go with one with the sexiest ads? And I have to say that we all are more influenced by ads than we realise, and there are ads around. Some of the big providers advertise quite a lot, and I think I hear a lot of people are in their funds, and I think, I wonder how they chose those, because they're not ones I would have or have chosen. Just looking at a bit of data here, the mistake of expecting returns to continue. So every time, Morningstar is a company that comes out and gives the results of KiwiSaver funds and other funds in New Zealand every year. Every quarter, actually, they come out with results. And the most recent results I was looking at the other day, so when we look at 9 moderate funds, those are the lower risk ones, they call them moderate. The best performer in 1 year came 6 out of 9 over 10 years, and the last performer in 1 year was first over 10 years. And then when you looked at aggressive funds, you got the one that did best in 1 year, it was 3rd out of 5 in 10 years, and the one that came 4th in 1 year was first over 10 years. In other words, it's all over the place. The ones that have done well lately are not necessarily going to be the ones that continue to do well, and that happens all the time. I imagine those of you who are with Cambridge Partners, you'll have people, your advisors there will be telling you that very thing. You can't count on what did well in the past to continue to do well. I say at the bottom, this is not always like this, because there are some instances where some of the providers have actually kept on doing well year after year for quite a while, but it still won't necessarily continue. The S&P, Standard & Poor's, which is a huge, big international company, originally American, does this sort of research. This is their American results, but they get similar results all around the world. They haven't looked at New Zealand yet. I hope they do one day, but they have in Australia. So what they found was the US equity funds, which are share funds, which are just like the higher risk KiwiSaver funds. The ones in the top quartile, so the ones that did best in the top 25% in June 2018, only about 41% of them were still in the top quarter a year later, and only 36 were after 2 years. After 4 years, it was only 4%, and after 3, and after 4 years, it was none. In other words, the ones that did well didn't stay doing well. It's the same old story. And if you want to go over a longer period still, this is some interesting data over 2 decades. So we're looking, so it starts in 2010. You've got 5 American fund managers who were nominated for Fund Manager of the Decade at that point. And they started in 2010. From 2000 to 2010. So they were fund managers of the decade, and so they're the ones at the top, and coming through at the bottom we've got the dark blue and pink. Those are the indexes. Those are the basic market average performance. So all of these other ones in that decade did way better than the market average. But 10 years later, have a look at this dark blue and pink ones, which were at the bottom, there at the top. So all of those ones that did really well for a whole decade did worse than average in the following decade. So they were the top ones in one decade, way down in the second decade. And I've got a note to check out the light blue one, which was the very top performer in the first decade, and they're right down at the very bottom in the next decade. So just because you see one of the fund KiwiSaver providers that's done well for quite a few years, I wouldn't count on them continuing to keep, because around the world the same sort of findings keep getting made, that they don't continue to keep doing well. So why don't they? Why don't winning managers stay winners? Often it's because they tend to take a bit more risk, and that does very well or very badly. They're playing the risk game there. Another thing that we're not aware of is that if you do get a manager who is particularly good at picking shares and picking out which ones really are going to do well, which is a very rare skill, the people in the industry are going to know about that person, and they're going to hire them away. And we don't know that. We just stay investing with our KiwiSaver provider. We don't know who's making the choices there. And finally, there's a huge element of luck in it. The ones that do really well for a while, there's often an element of luck in finance that we don't all realise. So what about fees? So I've said we don't necessarily go with the ones that have done the highest returns lately. Should we go with the ones that charge high fees? Because you'd think if they charge high fees, they must be better, or how do they get away with charging high fees? So this is data from the Financial Markets Authority, and so we're looking at aggressive funds over 5 years. Aggressive, so they're the riskiest of the KiwiSaver funds. And across the bottom we've got fees, so the further you are to the right, the higher your fees. And up here we've got average returns over 5 years. And so if the high fees went with high returns, you would expect there to be a line like that going up the graph. Low fees, low returns, high fees, high returns. But it's all over the place. Look at that high fee one over there. It's got one of the lowest returns. And the two that have got particularly high returns are among the lowest fees. If you look at that graph, you've got to say there is no correlation between fees and returns coming through in that graph. Any questions or comments about that? It's people don't believe it quite often. They think, no, they must be good. They charge more. Low fee funds do as well as high fee funds, and this is true in the KiwiSaver market and the non-KiwiSaver market in other countries. It's just true all the time. So I just say, look, go with low fees. There's not much good looking at past returns. The only thing about past returns are if you were looking at a fund and they would kept on doing below average returns, you wouldn't really want to be in them. But beyond that, I would say ignore returns and go with low fees. So, okay, here's one example here. If we're choosing low fee KiwiSaver provider, this is just an example pulled out of the air, really, of deposit of $250 a month and returns of 5%. So on the lowest aggressive fees, you'd end up with $359,000, and on the highest, you'd end up with $223,000, which is $136,000 less over 40 years. It's a huge difference, assuming that the high and low fee ones have got an equal chance of getting good returns, which is what we're assuming. Think what you'd do with $136,000. It's a massive difference. So if you wanted to look into fees, the Smart Investor tool on Sorted it's really good. It's got a heck of a lot of information in it. Some of you will know it. All sorts of quick summaries about each KiwiSaver fund. Ethical KiwiSaver funds. Now, some people are not at all interested in this, and some people are very interested in it, and it's the main basis on which they choose their fund. And more, the interest is growing every year. Some providers have ethical funds, and most of them avoid the bad industries, the alcohol and cigarettes and pornography and armaments and those types of sin stocks, they're sometimes called. Some providers do more than that, especially increasingly these days. There are providers well, some of them actually invest in the bad companies so they can go to the annual meetings and ask awkward questions of the management and these sort of activist roles. There are all sorts of different ways that people are taking an interest in the quality of the sort of ethical quality of the investments the funds make. The returns are sometimes better and sometimes worse. I got pulled up the other day on my program on Jesse Mulligan on RNZ. I mentioned that in the last year or two there's an index of ethical stocks that's done worse than average. And I did say that's not always the case, but nonetheless, some of the ethical investment firms came to me and said, you shouldn't have said that, Mary, because everybody thinks we do worse than average. And I said, no, gosh, I better put it right on the radio sometime soon. But it's all over the place. Some years the ethical funds do better than average, and some years they do worse. So if I were you, it's a bit like the low fees thing. Go for ethical if that's what you want to do, and you probably won't end up worse off. You might end up better off. It probably won't over the years make that much difference. But watch the risk level. Quite a lot of the ethical funds invest in shares, and that makes them one of the riskier KiwiSaver funds, and that's fine as long as you can cope with the ups and downs of a riskier fund. So there are ethical funds that invest in bonds and lower risk, but they're not as common. So just keep that in mind. Here's your website if you're interested in ethical type investments in and out of KiwiSaver. Mindful Money has got a lot of interesting stuff on it. It's good, it's well done. And this is one of the first tools you come upon on that website. It's inviting you to exclude the issues that matter to you. So you might only really care about animal cruelty, so you can click that. You can click the whole lot if you want, but you can zero in on the ones that matter to you. And then it'll tell you, which KiwiSaver funds and at whatever risk level might suit you with your particular choices there. So in summary on KiwiSaver, it's important to find your type of fund, go with low fees, check the ethics if that matters to you, switch to the best provider. How do you do that? It's very simple. So if you think, gosh, I'd quite like to change it, oh gosh, it'll be hassle. All you have to do is go to the new one, the one you want to go to, and say to them, I want you to move me to you. You do not have to go to the old one and say, I don't love you anymore. They do that for you, so it should be very easy. Now, as I'm saying this, I'm conscious that earlier on I said I'd talk in a minute or two about KiwiSaver for retired people, and that's actually in another talk I sometimes do, not this one, sorry. So I'll do it now anyway. Once you get to 65, the government money stops. And during the year you turn 65, you get a proportion of if you're 65 for 3/4 of the year, you'll get 3/4 of the 521 from the government. And after that it stops. Employer contributions can stop. The employers are no longer legally obliged to keep giving you money, but a heck of a lot of them still do. If they've been giving it to you, a lot I talk to you say, oh, I'm not going to suddenly say you can't have that anymore. But it works really well for retired people, and a lot of retired people are not in it because they when KiwiSaver started, you weren't allowed to join over 65, but now you are. So if you're not in, you can join at any age. And the things about it are, they're very similar to other managed funds outside KiwiSaver that you might be in, but the fees are quite often lower. So you get quite a lot of the providers will have a KiwiSaver growth fund and a non-KiwiSaver growth fund, and a KiwiSaver balance and a non-KiwiSaver balance in parallel that are very similar. The KiwiSaver fees tend to be a bit lower because there's more competition and the FMA is watching them. And that's the other thing about KiwiSaver. I think I used to be on the board of the FMA for 9 years, from when it started actually, and I used to notice when around the board table, if KiwiSaver came up, people sort of sat up and said, "Ooh, we've got to be careful of this." The government does not guarantee it, but they're watching it very closely. They're very aware that if a KiwiSaver provider, if a KiwiSaver provider goes out of business, and there have been some, there've been quite a few, your money just gets moved to another provider. If you were with that provider and they go out of business, your money simply gets moved, because it wasn't their money anyway. They were just the instrument through which the money went into the investments, and the government watches that very closely. Every provider's got a supervisor making sure that the provider's doing what it says it's doing. The possibility of you actually losing money in a KiwiSaver fund in reality, I'd say it's very low. It would mean that the supervisors had to be in cahoots with the provider, and no one else caught what was going on. So that's one reason why I think all the way through to when you die, it's not a bad idea to be in KiwiSaver funds, because they're being watched pretty closely by the government. But it isn't as good, because you're not getting the government money. I have to admit that. Any questions about that, about KiwiSaver for retired people or over 65s? Diversify. So Scott was talking about that earlier, the importance of it, but and I'm sure you all understand it here, but there's a few points to be made. So there's 3 types of diversification: having your money in several different types of assets, and then within each type of asset having lots of different shares or bonds, etc., and internationally. So the 4 types of assets, look, I'll go through this very fast because you all know about this. Cash and bank term deposits. I put the bank in red because I'm not that keen on the non-bank term deposits. They pay higher interest, but it's for a reason. It's because they're riskier. Otherwise, they wouldn't get you money. So I would, if you want to take a bit more risk to get a higher return, do it in a managed fund, KiwiSaver or otherwise. Don't do it with term deposits, would be my suggestion. High quality corporate bonds or a bond fund, property and shares. They don't all crash at once, it's all pretty obvious. And here we can see green line is New Zealand shares. This is $1,000 invested in 1973, and it's grown to 120. 1,000 has grown to 120. That's incredible over the years. And then we can see New Zealand commercial property and overseas shares, etc., and bonds and inflation down the bottom. You can see that the risky assets have a much rockier ride. You can see the 87 crash here, where the green one goes down, and then the red one goes up and down. That was the tech bubble and crash that didn't affect New Zealand shares, but it did affect world shares. And then we've got the global financial crisis, where the green and red both went down, and coming on through there. Much rockier ride, but you end up with much more money going into those higher risk assets. A little bit more about cash and bonds. Different bank rates are on Interest and CanStar. I love looking at those. Do shop around for your term deposits, etc. Interest.co.nz's got some really good, easy to absorb advice on different term deposit rates, etc. Don't be loyal to your bank. They're not loyal back to you, honestly. Laddering your cash. This is something that people love, and it's actually a conversation ongoing in my Herald column at the moment. And by the way, I write a Q&A column in the Herald. A lot of you probably don't subscribe to the Herald because you're not in Auckland, but it's on my website as well every Saturday morning, free. Don't tell the Herald I told you that, but it's there. and we're having an interesting conversation. Lots of people write in about certain topics and we get arguments going. It's good fun. About laddering at the moment. So basically what we're doing here, let's say you had $100,000, rather than putting it all in the bank for one term, you put, starting at the beginning, you're going to put a quarter of it in for 1 year, so it matures in 24, quarter in for 2 years, etc., going through. And then as each one matures, you renew it for 4 years. So you see where we're going here? At the start, you've got to set it up, but then after that, you're rolling it over every 4 years. And what that gives you is frequent access. It means that you're getting access to some of your money every year, but at the same time, you're getting higher interest that you can usually get on longer terms and term deposits. Currently, actually, that's not true. It's a weird thing going on in the markets at the moment. I don't know whether you've noticed it, that you get, for up to a year, you get more for a year than you do for 9 months and then 6 months like that. But from a year to about 5 years, the interest rates are about the same. And that's a weird phenomenon that happens occasionally, and it means that the markets think interest rates are going to go down. But it's unusual. Usually you get more interest if you tie your money up for longer. So by doing this laddering thing, you get that higher interest rate, but also access to some of your money every year. So it's quite a popular thing for people to do, quite often in retirement actually, but not always. Shares, investing for 10 years or more, you've got to promise you'll panic when, not if, the shares halve. And never bail out when things go bad. It's horrible. And if you've got a good advisor, I bet some of you have been through that conversation with them in 2020 when we had the COVID crash, and then more recently. Don't do it. But if you're nervous about, there'll be some of you here who, particularly often women, which is why I see in my picture we've got the woman being too cautious and the guy actually being too brave, and that's quite common in investing, not always, but quite common. If you're saying, oh, I don't want to put money in shares, they might go down, perhaps just put a small amount in and leave it there. Within KiwiSaver or out of KiwiSaver, within KiwiSaver, with just about every provider, you can have some money in low risk and some in high. So you can experiment with it. Don't be too shy, because shares and property give inflation protection. Looking back at the graph, we've got inflation going across the bottom. Those are the ones that will grow more than inflation. Yes. 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 So you're wanting to pay extra off the mortgage at the end of... Yeah, I understand what you're saying. So, yeah, so you could put the money to effectively reduce the mortgage rather than... Yeah, and generally I think that's a better thing to do than investing in shares, because it's a sort of guaranteed return. It's a return as good as the mortgage interest rate. So if the mortgage interest rate was 5%, it's like you've got 5% after fees and after tax, guaranteed. Now, in shares on average, you'll probably do better than that, but it's riskier. So it's 6 of one, half a dozen of the other. And in my column a while back, when interest rates were so low that mortgages were 2 or 3%, and people were saying, well, I can make more than that in shares. And that was true. There was a better chance of making more than 2 or 3%. I still think it's a really good thing to pay down your mortgage, though. It's psychologically good, and it's really good. I had a letter in the column the other day from a woman saying, oh, I've got equity in my house and I feel I should be doing something with it. I should be investing it in property or something, even though she was a risk-averse person. And I said, no, don't. enjoy the fact that you've paid down this debt, and it's like emergency money. If you've got equity in your house and something goes wrong, and sometimes crises happen, family crises, or your house suddenly gets red sticker because there's a landslide ploughed into it. Things happen. Well, I'm talking to Christchurch, for goodness sake. So it's really nice to have equity in your house. And so getting rid of that mortgage is great. Yeah. I would never argue against putting money into that. Yeah. Okay, so moving on. Rental property. People sometimes say I'm anti-rental property, and I'm really not, but it can often go really well. But there are two problems in retirement with rental property. You can spend only the rental income. You can't gradually spend the capital, as opposed to having your money in a share fund or some other kind of a fund where you can gradually use it up. People these days they die with their own home and their rental property, so they might have $2 or $3 million tied up in that, and they haven't been having as good a time as they could in retirement. It's a real pity. You want to be able to spend that money. And then there's the hassle, the no tenants, bad tenants. And you can get a property manager in, but then they cost money. And someone wrote to me recently and said, well, then I had problems with my property manager. So some of you in this room, I'm sure, have got rental properties, and look, if you enjoy having them and you've got enough money without selling them to have a lovely time, whether you're retired or not, that's cool. But don't be retired, short of having fun in retirement because you've got it all tied up in a rental property. It's a real pity. So that's just a thought for people. Now, this is an interesting graph that a friend of mine made for me the other day, and I thought, wow. And in fact, something that Scott was saying earlier relates to this really. In 2022, we had a really bad year over the calendar year, in not just the higher risk funds in and out of KiwiSave and shares in general, but also the lower risk ones, because bond values went down as well because interest rates went up. Basically, when interest rates go up, the old bonds, which were issued at the lower interest rates that are sitting there in the funds, are not worth as much anymore. No one wants to buy them because they're now at a low interest rate, and so their value goes down. And that's why we had a bad year for bonds. But it was very unusual. This is 50 years in New Zealand. So down in this bottom quarter, we've got the years when, we've got share returns across the bottom. The further over to the right, the better it is. And going up here, we've got bond returns. The higher up, the better it is. And so down in this bottom quarter, we've got years when shares went down and bonds went down. And it's happened only twice in 50 years. So last year was very unusual. It was very unusual, the two red dots. So the orange dots are when the shares went down, but we were saved by being in bonds. And that's the point. Usually, if you're in shares and bonds, when one goes down, the other goes up and offsets it. So all those orange years were years when the share market went down, but we were saved by bonds going up. And then we've got a few green years when the share market went up, but bonds went down. We weren't too fussed about bonds going down because shares went up. And then we've got all those blue years where everyone was happy because they both went up. I hope you can follow that. The point is, it was very unusual what happened last year, and generally speaking, it's a really good idea to have some money in shares and some in bonds, because often they both do well, but in the years where one goes badly, very often the other does well to offset it. Okay, so you also want to own many different shares, many different bonds, and many different properties, not just the one, so they won't all crash at once. So I'm going to have a look at how to do this easily, but first I've got a sad story and a look at the world's biggest shares. So the sad story, this was a guy that wrote to my column in early 2020. I'm up about 250% on what I paid for Auckland Airport. He was writing to me to say that he didn't agree with me that you should diversify shares. He was saying, got one share and I've done really well with it. And then look what happened. It was only a month later, actually, when COVID hit, and that's the price of the Auckland Airport shares suddenly plunged. And it's recovered a fair bit, but it's still not up to where it was when he was so happy with it. The point is nobody saw that coming, like my little boy with the water, dropping the water on his dad. Nobody saw that coming. If you're on any individual share and think it's doing really well, quite often things come absolutely out of the blue and hit that one company, so it's not a good idea to be in just one or just a few companies. Now we're not going to go in detail on this, but this is the world's biggest shares in 1980, 1990 going on through, and if you just glance at them, you can see that the same ones don't stay the biggest. Over the years, they come and go. Going with, whatever's powerful 1 year, 1 decade, won't follow through the next for very long. The easy way to diversify is in managed funds, including KiwiSaver. You've got lots of bond shares, property, etc. Pros and cons. The advantages of funds are diversification, a lot less work for you. Now, there we go. Going offshore. Best and worst countries. So we've got best country each year from 1985 on. That was the country that performed best. What I looked at was New Zealand, Australia, and the biggest share markets around the world. And here's New Zealand doing best with 111% in 86 and doing worst with minus 44 in the 87 crash, which some of you will remember. They're the ones that did well, they're either top 1 year and bottom the next year or the other way around. And we actually had Australia and China swapping places down there near the middle. In other words, there's a lot of times that a country or a share market does really well and then it crashes, or it crashes and then it does really well. It's a common thing, and that's why bailing out is not a good idea, because quite often, right after you bail out, when a market's doing badly, people just start realising this is getting stupid. The shares aren't that bad, and buying them in, and the market zooms back up again. So it's a really good idea to be in a wide range of different countries. The easiest way in New Zealand is to do it in a fund that's managed in New Zealand, KiwiSaver or otherwise. The estate and taxes are much simpler. Being braver about risk. So there's risk and return, and looking at your asset mix there. So low risk is relaxing, but you don't have as much fun. Yeah. High returns make a big difference over the long term. So you can see here the 3% in red and the 7% in blue. Over 20 years, you're starting to get quite a big difference in your savings total, and especially over 40 years. So if you're taking high risk over long periods, it makes a massive difference to how much you accumulate. So time periods dictate everything as far as I'm concerned. And when you're deciding about the time periods for your money, when you're going to spend it, it's when you expect to spend it, not when you retire. So someone wrote to me the other day and said their KiwiSaver provider had said to them, "You're getting near retirement age, why don't you move all your money down into low risk?" And I wrote back and said, "This is mad. You only move down to low risk the money you're planning to spend in the next few years." Because, as Barry was saying earlier, we can live for 30 or 40 years after we retire. You don't want to move it all to low risk at that point. Put the money that you're going to be spending within about 10 years into low risk investments is my suggestion, term deposits or cash funds. If you're going to spend it in roughly 3 to 10 years, get it into bonds or a balanced fund, middle level investments, and then the rest of it, New Zealand and international shares or a share fund or property, as long as you can cope with the ups and downs and you don't bail out when things go wrong, because that's a loser's game. Over 15 years, the ride is much smoother. So we've got 1 year returns are all over the place, ranging from 80%, this is international shares, to -40. But by the time we're looking at 5-year returns, there aren't that many times when there are losses over 5 years. Over 10 years, it was only in the global financial crisis that there were losses over 10 years, and over 15 years, never. So you get that watering down over longer periods. The volatility is not nearly as bad when you look over longer periods. This is another sort of slide saying the same thing, really. Riskier funds work well over longer terms. So if you invest over a single year, there's about 1/4 of a chance in an aggressive fund, the highest risk funds, in and out of KiwiSaver, that the balance will go down. In a balanced fund, it's about 1 in 7. But as you can see, coming down, by the time you get to 10 years or more, it's almost never does a fund go down. A fund investing fully in shares go down over a 10-year period. In a balanced fund, that is never really 1 in 1,846 years. Keep contributing. Just a couple of aspects of this. It works even better in downturns, and look at the cost of a savings suspension. So dollar cost averaging. This is ridiculously oversimplified, and I don't like the name dollar cost averaging because I think it's a bit confusing for people, but bear with me, and I hope you get the gist of it from this. Let's say you're contributing $100 a month. It could be a KiwiSaver fund, or it could be any kind of investment where the value of the units go up and down a lot. So it'd be a riskier KiwiSaver fund or other fund or share investment. So if the value of the units is going up and down, which is what happens when your KiwiSaver fund balance goes down, you've still got the same number of units in the fund, but the value of the units has gone down. So to oversimplify it, let's say that sometimes the units are worth $10, and so your $100 buys you 10 units, and sometimes they're worth only 5, so your $100 buys you 20 units. Okay, so looking over the 2 periods, you paid $200 and you got a total of 30 units. Now the average market price is $7.50, halfway between the 10 and the 5. But your average price, to get your average, you paid $200 for 30 units, so 30 into 200 is $6.67. So the market average price is $7.50, but your average price is lower than that. So why did you get to buy? Why did you get this bargain? Why is your price lower? Yeah, that's sort of I'm looking for another way to sort of put it. I think you're probably losing people, but basically you bought more when they were cheap. Is what happened. It's like we might buy more peaches when they're cheap than, at the beginning and end of the season we don't buy many, but when they're cheap we buy more. And that's what you do without even realising it. If you're putting the same amount of money in, you get more when they're cheap and fewer when they're expensive without even realising it. And that's why it works so well to just keep on putting the same amount of money in, and especially when the markets are going down and the unit prices are going down, and the balance of your account is going down, that's when people say, I don't want to put in any more. And that's the time when you really must, because you're buying bargains. And have faith, it'll go back up again. And so it's really important not to go on, savings holidays or whatever when the markets go down. That's the time. And in fact, there are people out there called contrarian investors who make a point of buying more whenever the markets go down. They say, everyone else is selling, I'm going to get in and buy. And the research shows that they do a lot better than the ones who do the opposite. But actually the ones that do best of all are the ones that just go to the beach. The stocks are on sale, absolutely, yeah, that's right. And for some funny reason, when peaches are on sale, we're fine buying them, but when stocks are on sale, people panic and think they're going to stay down, but they don't. Well, individual ones might. And those of us who remember the 87 crash, some of them went down and down and then down to zero. But in a fund, that's not going to happen. Okay, one more slide here about contributing regularly. If you stop for just 1 year in KiwiSaver, you can go on a savings suspension. So you miss out on the employer and government money. And you can see, if you were a 25-year-old earning $60,000, by stopping for a year, you saved $1,800, but you retired with up to $40,000 less dollars. So yeah, so for a 25-year-old, they saved $1,800, but they missed out on $40,000 if they were in a higher risk fund. For a 40-year-old, it's not quite as bad, but they saved $3,000 and missed out on $23,000. It's a real pity when people go on saving suspensions. I suspect that's going to start happening a bit in the next year or two because mortgage prices going up so much. But if you know anyone or you yourselves are tempted to stop with your KiwiSaver, try not to. It's a real pity. Okay, this is my favourite bit. 3 don'ts. Don't chase recent returns. Don't try to pick shares, and don't try to time markets. That's my brother there having a nice time. Remember this. So the point of this was don't switch around. Don't switch providers because of returns. Here's a true story. A man complained to KiwiSaver, his provider, because his return was -5 for the year. The provider looked into it and said each month the man had moved to the best performing fund in the previous month within the KiwiSaver. He did that 11 times. He did it every month until the end of the year. If he'd stayed in his original fund, he would have made 9.2. It's shocking when people chase after what did well in the past. The only good reasons for switching fund types are that you're getting closer to spending the money. It might be in retirement or it might be on a home. Or you can't cope with volatility, in which case move and stay moved. When people, KiwiSaver, because it started in 2007, but people didn't have much money in it, or a lot of them hadn't even joined yet when the global financial crisis happened. And then after that, from about 2011, KiwiSaver there were a few little blips, but hardly anything. People got horribly used to the fact that didn't think KiwiSaver ever went down, and when 2020, when the COVID crisis happened and suddenly the markets plunged, lots of people, I got so many letters to my Herald column about were moving out moving to lower risk KiwiSaver funds, and then they were planning to move back up again, and none of them would have got back in time to catch the upturn. That was an astonishingly fast downturn and then upturn, and no one can time when it's going to. If you find you can't cope with the volatility, by all means move down, but don't try moving back up again. Don't react to what's happening in the markets. It doesn't work. It's not just funds that change, so we've got, it's getting late, isn't it? I'll go quickly through these. So this is the best shares and worst shares for all these different assets. So in 2005, New Zealand bonds were best, lowest return, and in red, and commercial property was highest. And if you just glance through that, you can see that different types of assets have good years and bad years, and quite often it was moving from worst to best and best to worst in single years, just like the countries we were talking about before. Same with types of assets. This is a more nuanced, same sort of thing. All of these are the different years and in order of what did best at the top and down to what did worst. Big mess. When you pull out of that last table, shares, property, cash, etc., they're all over the place. So it's all just a big mess. Okay, second, don't try to pick shares. Even the experts get it wrong all the time. So Warren Buffett says, what I just cannot get investors to understand is the difference between a good business and a good investment. When I bought Coke at $6 a share, it was a great company and a great investment. It's still a great company, but at $44 it is no longer a good investment. It's a common mistake. People say, this company's looking good, I'm going to buy shares in it. The people, the experts, the fund managers saw that long before you did. They ran in, bought the shares, pushed the price up because of the extra demand. By the time you buy it, it's too expensive. It's not a good investment anymore. People think they can pick which shares to invest in, individual people, and we can't. People there sitting there saying, I can. I bet you're not remembering some. You're remembering the ones you did well with. If you can, you're very unusual. This is the guy, remember the airport guy, he thought he'd picked the right one. Yes. Don't try to time markets. So traders and market timers, people who are trying to pick when to get in and out of the market. So some American research, the average mutual fund investor is in grey, doing a lot worse than the average fund. Research just keeps on showing that. And another piece of research, we've got market timers don't win. So the average investor in orange earned 7.13, the Standard & Poor's 500 index earned 10.65. And if you look at the difference between 7.13 and 10.65 over the years, so over 20 years, 100,000 would grow to 411 or 818, so twice as much. If you just got into an index fund that invests in the S&P 500 index instead of trying to pick which shares to buy and sell and trading in and out. Warning to market timers. So this is all the years when the New Zealand share market went down from the 87 crash on. I've put in red the ones that were particularly bad, 87 crash, 1990, and the global financial crisis were the ones. The year after, nearly always, we got a very strong return. After the 87 crash, it took a couple of years. And 2021, it was barely down. And then we did get a negative year after that, which was 2022. But generally speaking, after a bad year, look at those numbers, 34, 20, 27, fantastic returns. People who say, oh, I don't like the look of it, I'm bailing out now, very, very often miss what's going to do well the next year. So work out the best investments for you and stick with them. Finally, independent advice. If it's all looking too complicated, get advice. Now, I realise I'm talking to an audience where a lot of you are getting advice. I get a lot of letters from people saying, who's good at giving advice? And I don't really know because I haven't sought advice myself because I haven't felt I needed it. But some advisors charge you nothing. This used to be common. It's got less common lately, but it used to be common. And people would say, well, why would I pay when I can get it free from this person? One advisor, I had a letter, this is a few years back now, from somebody who said their advisor, they'd sold their batch and they got $2 million from it, and their advisor put them in 2 bonds, put that money into 2 bonds. And they wrote me a letter when the $2 million had turned to $1.6 million and said, and I said, well, who told you to do that? And I mean, it was shocking, and it turned out that the advisor had been paid a commission to put that money there. Whenever you're getting advice from someone, and this includes banks, they'll give you free advice sometimes about what to do with your money, but they're not acting in your best interests. I mean, why would they? If you're not paying them, it doesn't work. It's best to pay fees. You get professional advice, and it might be a percentage of your investments or a flat fee or an hourly fee. Years ago, about 15 years ago, I started putting on my website a list of advisors who charged fees because I wanted to encourage people to go to them. And Cambridge partners were on it, I'm sure they were. And it got too much for me in the end, the admin of it, because it grew from about 10 or 12 to over 60, I think, in the end. So I've moved it now off my website, and it's on Money Hub's website. They sort of took it over from me. But I've left on my website a page about how I reckon you should choose an advisor. Now, Cambridge Partners hasn't dictated any of this. This is what I honestly think. So if you want to get some thoughts about how to pick a good advisor, you might want to have a look on my website. There's an article there on info on advisors that tells you where to, and gives you a link through to the Money Hub's list. But okay, get rid of credit card debt, pay down your mortgage, be in the right low-fee KiwiSaver fund, mix your assets and hold lots of each one, invest offshore. The easiest way is through funds and investment periods. Really important information that, I think, for the short-term money being in low risk, so that when you're getting the money out, you won't suddenly have it turn turtle on you right when you're going to take it out. Don't chase returns, time markets or trade, and there'll be people in this room I know who will do all those three. And look, if you enjoy it, and if you've got enough money to do it, as this gentleman near the front says he's done that kind of thing and he's still got enough money, that's cool, but you're probably not going to end up as well off. Need advice, pay for it. I used to lecture at Auckland University in financial literacy, and I used to love showing this graph to the students because they all thought that started off happy, and they related that first half, and they thought happiness just went down and down and down your whole life, and until you died. And I used to say to them, how old are your parents? And they were always around the middle there, and I said, do you reckon you could have anything to do with it? The fact they're down there. But anyway, it's a lovely, comforting graph. And if you remember, Barry showed a very similar graph. I think it was American, wasn't it, Barry? His one. But anyway, this is New Zealand data, and the same thing, that people report their happiness going up as they get older. So the black. Oh, it's just different years. If I can. Oh, there is a black one there. It must be the very lowest one. They're just 3 different years, and that must be just the very lowest one, I think. Yeah, we're only 1 in 5 people at that age group reported that they were happy. The happiness research I've written in this book, my yellow book. I think you're going to get given copies of this one, which is based around the Q&A column in the Herald. This one includes information about money and happiness, and the interesting global research that showed that up to a certain level, people having more money, up to a certain income level, people having more money were happier, got happier as they had more. If you can't feed your children and you get more money, well, of course you're going to be happier. It was just at a certain level, it leveled off, and then it actually went down. So people at higher income levels, their happiness was going down, which is, we can only speculate on why, but it's really interesting. And they asked people 2 questions. One was, on a scale of 10 steps, look at your whole life. Happiest is at the top and unhappiest is at the bottom. And the other was, what was your dominant mood yesterday? And they asked, lists of different emotions. So interesting to think about, yeah. But anyway, time I went and we had a drink. I should stop throwing this around the room. Yeah, so we've got rid of the 2 books. So if there's any questions and comments, or would we rather go straight to there? So whoever won the books, just come and grab them shortly. Thank you.
Thank you, Mary. A lot of wisdom in your presentation, so thank you very much for that. We are very near the end, and I'm sure a lot of you are ready to have a drink, which is being organised at the moment. We just wanted to very briefly look at the Slido questions that were asked. So if I could ask our panel to take a seat on the front there. There's 2 or 3 questions. We'll cover those and then we'll close. So Barry and Mary, and is Scott there? Yep. And you'll notice that we've also been joined by a person who you haven't heard from yet, and that's Dominic Sheehan. Dominic is an advisor at Cambridge Partners. He's head of advice and is also head of our sustainability approach, both as a company and within our investment portfolios. So I will, here's Barry now, I will grab the questions, and there's only 2 or 3 of them, and we'll see if we can answer those. Okay, so the first one is actually for you, Dom. Question is, what is Cambridge Partners doing in the sustainability space for the growing climate crisis?
Well, thank you very much for the question, and it's lovely to see you here today. Is that a bit better?
Yep.
There we go. So yeah, actually for starters, lovely to see you all. Thank you for coming out on such a rainy day. Thank you for the question, whoever it was. I suspect it may have been a Cambridge Partners employee, but nonetheless. So climate change and sustainability in general is something that we've been aware of as being an issue that we have a lot of responsibility in regards to, not only from a business standpoint. Cambridge Partners is a company, we have a carbon footprint, etc. But also we work with clients who have capital which is invested in the markets, which can influence what happens in regards to climate change. And so I suppose there's sort of 2 areas that we're trying to address this primarily. That first piece, Cambridge Partners as a company looking internally, we recognise that we go back a couple of years, didn't actually know what the story was in regards to what type of impact do we have and how can we address this. And so over the last 12 months, we've been running a project with an organisation called Toitu EnviroCare to measure what our emissions are, put a plan in place to reduce them and offset them. And so we've actually just completed our first audit for the year that ended on the 31st of December. And you may or may not be interested to know that Cambridge Partners is responsible for 60 metric tonne equivalents of carbon dioxide. So we have identified that now, and we're currently in the process of offsetting that with 100% permanent New Zealand native forest, which we've taken a philosophical approach as being, offsets, they're easy to argue with, but if you are going to offset, the best way to do it is permanent native, so that we've taken that approach. And also we're in the process of putting a plan in place to reduce our emissions to get them down as low as possible. And then separately on the other side, many of you have your investments invested with us through one of our sort of sustainability strategies. And in doing that, a lot of the fund managers that we work with and we invest your money in, they have also been making conscious decisions to either emit companies or underweight companies that have a high carbon footprint, or for other funds there, as Mary mentioned, they're the type of fund managers that go along to the annual meetings, they'll invest in the dodgy companies and they'll ask the hard questions. So I suppose that's how I see that we play our part, both from those 2 elements. We give you the option, if you're interested, to invest your capital in a way that will hopefully have a positive impact, and also we're looking internally for what we can do.
Great, thanks Don. Scott, someone would like you to get your crystal ball out and advise them where you see term deposit rates in 2 years' time.
Oh boy, my crystal ball's always very, very foggy. So with that, I suppose disclosure and disclaimer aside, so 2 years out indicates that something's changed in terms of inflation. So the Reserve Bank last year said that its job was to control inflation, and they were trying to effectively engineer a recession. We might have one foot there this year. 2 years out, the Reserve Bank is itself expecting to be reducing rates. So lower, which is exactly what the market's telling us.
Great, thanks, Scott. And Mary, I think you've probably covered this, but very briefly, should you put money towards paying off your mortgage, or are you better to regularly contribute to your investment portfolio?
That question might well have been asked before.
Yes.
A member of the audience asked it directly. But yeah, I mean, look, it is debatable, but personally I think get rid of that mortgage. It's good psychologically, apart from anything else. But as far as an investment goes, it is 6 of one, half a dozen of the other often. Yeah.
Great, thank you. Barry, you've been such a good man that no one actually had a question for you. So we're going to let you off lightly. Thank you.
Rates are going down. I'm sorry.
Yeah. So thank you. Panel. I'd now like to call to an end our 2023 client briefing. I do hope you've enjoyed it.